AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today.
Warrior Thursday.
Warrior Thursday. They can close it out. I imagine a lot of people are watching that game tonight.
A lot of money on the line.
I think it's. I wouldn't say that. They already get money.
A lot of betting money on the
line. A lot of
betting.
Okay, there you go.
There we go.
I saw one guy bet a whole bunch of money on the Warriors. With that said, a lot of people want to hear about real estate. Mortgage rates are definitely the story right now. 30-year fixed, according to Freddie Mac Weekly survey, is 5.78%. Yes, 5.78%. And it's had the largest increase in rates that we've seen since, I think, 2008. We also have the largest rates, the highest rates since 2008. So we're 14-year high on mortgage interest rates, Gordon.
Well, we've also had one of the largest increases the Fed's done in many, many years, 0.75. Typically, over the last 10 years, the most they've gone up is a quarter or a half, but now they've gone up 0.75 basis points. So that's why our mortgage rates are so high on the streets.
Yeah, so this is starting to really trickle into the mortgage rates and affordability, and that's really what a lot of people are looking at as, you know, what it takes to buy a house. Affordability is the main driver behind a lot of these home prices that we saw. The year-over-year double digits in many cases, depending on where you were. And I think people are starting to get a little worried that, you know, seeing that a mortgage payment on average last year was in the 1,600s and now it's in the 2,500s. So you're looking at, you know, roughly 50% increase in your mortgage payment just because of interest rates and then, of course, the higher home prices. We expect to see home prices level off, at least, Gordon. Regionally and locally, and wherever local you're going to be, we're going to see, you know, micro changes based on, you know, the quality of the house, the neighborhoods and schools and so on. But I think nationally, we're going to see this really kind of, I think we're going to see a 5 to 10% hit. I sent out a survey on Facebook to see what people thought. That should go out today. What are your thoughts, Gordon?
I think we definitely would see a hit. Of course, the better neighbors, more desirable neighbors, are less of a hit. But I'm seeing it already. As we talk on the show weekly, I'm seeing those price reductions. I saw a price reduction came across the desk condominium here in Piedmont. Lowered price $76,000. They lowered this condominium price. It's about 15% price reduction. If it sits on the marketplace, especially if it's vacant, it's been staged, there's money's being spent, and you got to move the property. So these people, fortunately, were in a position to, you know, do a price reduction. Or some people might have to move back in if they couldn't sell the property. So a lot of different things happen in these markets. We're going to start to see a lot more creative financing. I'm assuming we're going to see some type of seller assist financing come back into the formula. So I think when, you know, market gives, something takes. When the market takes, something gives. So I'm expecting more creative finance and a lot of more different products coming out in the market. You were talking about FHA now. There's some FHA announcements.
FHA is now taking employment for less than 12 months. So there's a lot of really, you're going to see lenders really opening up their guidelines to try to drum up some business. And they have been. You go back pre-pandemic, and then a lot of those products were just wiped away, and they've slowly been chipping away back into the game and making it a lot more accessible to people. Now, there's a difference between accessibility and affordability. Affordability is just you do or you don't. Accessibility is, you know, how many products are available to the people that are out there, and those things are they're coming up, Gordon. And I think we're going to see more as this market tightens up. You know, we haven't gotten this many phone calls from lenders about, hey, you got any new loans? You got any new loans? Lenders are really feeling the crunch. Redfin and Compass, they just laid off 6 to 8% of their workforce because they're feeling the crunch. We'll talk about that in a little bit later. So a lot of the large companies are really starting to feel it on a large scale. So It really is starting to trickle in. The numbers we are just starting to see, it just keeps coming.
Well, I think we're talking to show real estate is probably one of the biggest widgets that employs the most amount of people in any industry. We're talking about title companies. Title companies, of course, are laying off people because refinances volume has fallen off. So therefore, there's not a need for that many title officers, escrow officers, or assistants. The same thing in the real estate office. More people don't need real estate assistants. The home inspection market,
lawyers, it just keeps
everybody,
going.
everything falls off because they're all tied to that one sale. So it's amazing if you was to sit down and navigate how much related item sales are sold on one house or how much employment is gained on one property from one transaction, and you'll see the fallout when the market slows down like this, how it affects the marketplace in more ways than you can ever imagine, more ways than you probably ever thought about.
I think the word you were looking for was not industry, but economy. It is. It's already trickling into the economy. When you start looking at layoffs, where are these people going to go? Okay, yeah, we have good employment right now. We have good wages. So I think we're going to see I wouldn't say a flood, but I think you're going to see a lot of people leaving the industry, looking for extra work. I don't think it's going to dilute the quality of any industries that are out there and bring down wages, but we're going to start seeing a little bit more want ads.
Well, that's what's happened in our business. In California Department of Real Estate announced last year that they had a record number of applications as real estate started doing well and people saw how well they were doing based on the prices of houses. Standard commissions 2.5% to 3% on one sale. Each agent probably just need to do one sale on a monthly basis to do very well. So a lot of agents have come into the business, and of course, now we're going to see a lot of those agents kind of back out, go back to what they were doing before, simply because there's just not enough volume to go around.
With that said, a couple other pieces. Again, it's just to get the numbers right. It was $1,692 was the average mortgage payment, monthly payment for a property. Today, that's $2,514. So you're looking at, roughly $800 and so increase. A couple comments from the chief economist at Redfin, Taylor Marr. The housing market isn't crashing, but it's experiencing a hangover as it comes down from an unsubstantial high. Housing demand has already cooled significantly to the point that the industry has begun facing layoffs. This week's rate hikes will further stretch homebuyers' budgets to the point that many more may be priced out. While a lot of these home sellers are already dropping their prices, more homeowners will likely decide to stay put now that the mortgage rate on a new home is significantly higher than their current one. That's what we haven't really quite seen yet. Now, we haven't talked about the home builders. Home builders are pulling back big time as well. So are we going to continue seeing low inventory? If that's the case, then I don't think we're going to see that big of a hit in home prices and home values. If we see more people saying, you know what, it's time to get out. I don't, my house is the highest it's ever been. Maybe we should cash out. Remember, there's a large portion of homeowners right now that are baby boomers looking to retire. A lot of them don't want to retire in that house, and they may have counted on that equity in their house as their retirement.
Right? Well, you just said a key word, equity. Speaking of equity, the Federal Reserve stated that the total U.S. home equity reached a record high of $27.8 trillion, according to the Federal Reserve. So you're talking about people are sitting on equity, but as home prices come down, that $27 million, which is of course, is a movable number, you will see more and more people look to go that way simply because of looking to cash out. Probably now as prices come down, of course, values come down. And when you look at cash out, of course, that limits the amount of cash out you can take on a property because we're normally limited to 75 to 80% cash out on most single family transactions. So it's all affected. It's a formula. Everything works hand in hand. But the most important piece that you did mention is consumer thought process. When things are down, people tend to like to stay down. When things are up, people tend to be up. So when the market was going higher, it fed more and more people to come in and buy because they thought that their product was going to be higher. But when the values start to come down, people start to back off and wait till it wants to see it go lower or hit the bottom, as we say, just like in our business when it comes to rates. When rates are going down, people just want to wait. When it start going up, then of course everybody jumps on the bandwagon simply because they don't want to miss the bus.
Yeah, it's just it's the timing too. You're right in the middle of the summer. We're coming up, and then going into the fall, the next largest buying season of the year. And you have an opportunity to say, you know what, we still don't see the inventory out there. Right now we're 15.9% higher year over year. Last week it was 13.8. The week before that it was 8, and then Before that, it was nominal. So we're seeing an increase in inventory. Now, if you want to catch that on the rise, before it gets to 30%, 40% year over year, and you really start seeing that inventory hit the market, and all of a sudden there's not as many buyers out there because of interest rates, then you might want to take advantage now. So this summer, I think, will be where we will see whether or not people are going to stay put, enjoy that low interest rate that they have, ride it out, and see what happens, or we're going to see a lot more inventory on the market. One or the other is going to happen, I believe.
Well, I think the latter, of course. I think we will see a lot more inventory in the market. It's because people have a lot of people have bought houses that are fixing properties up with planning on putting those on the market. So sometimes you can get caught, in a wrong position, and that's when you start to eat crow. A lot of times, there's a lot of people out there that bought resales. I don't like to use the word flips, that are working on them, and their projected profit margins will be a lot less than when they first bought the property. Matter of fact, I was talking to a realtor this week. A client put their house in the market for $1.7 million. They were looking to get a $2 million offer. Of course, none of the offers came anything close to that. Of course, the seller is very, very disappointed. Seller was actually pouting. And I told the realtor, I said, seller put this property in the market, 6 months ago. $2 million was not a phantom dollar amount. But as time changes, so does everything else. That's why we always have to be conscious of time. Time waits for no one. Can't put time back on the clock. So therefore, decision.
Inventory is still pretty low compared to the previous years. We're up from last year, 15.9%, but from 2020, we're still down 43.2%. Compared to 3 years ago, we're down 58.3%. So we're still down pre-pandemic, or the beginning of the pandemic, if you want to call that. So we have a significant way to go before we get back to the numbers that we saw. Do you think that we could get to a balanced market before we hit the inventory numbers, Gordon?
We probably will. Of course, it has to go through balance. You can't go from top to bottom without going through the middle. So we will go through a balanced market.
I think I said, do we get there quickly?
Probably so.
I'm thinking we will as well. I think we're going to see a lot more days on the market. We're going to see a lot more less over asking, and we're going to see more concessions, and it's going to keep kind of adding up together to get to that balanced market, and maybe into a seller's market, buyer's market. We'll see. If you have any questions, you can call the show, 800-516-1220, 800-516-1220. You can email the show, Tony or Gordon at bayarealoansource.com. We'll be right back.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
So we've talked a little bit about affordability and how interest rates are affecting the market. It really is what people are wondering right now is how their home value is going to be affected by this. And it directly is correlated to what buyers will spend for a house. And that's what it comes down to. Your house is worth what somebody will spend on it. What do you think is going to happen with comps? If we do see, sellers starting to drop a little bit, or at least get, they're not pushing too high over, the comps or the comparable values. Would you consider that something that's normalized in the market and can really kind of, if we see more inventory hitting the market, actually level off right there where things are just normal instead? They'll still sell fast, but people aren't willing to pay more than the comps that are out there. But are we going to have enough comps too?
Well, I kind of stay away from the word normal because I believe that with the pandemic, we established a new norm. I think what has happened over the last 3 years in real estate, everything was running up. You bought today was worth more tomorrow, and simply because of the demand and simply because of the supply. As we flip the script now, and now there's less demand and more supply, you're going to see those numbers come back. How far do they come down is the question. It's not easy to put a finger on it. It'll just be an alternative guess. But we do know that as more and more inventory come and rates go up, of course, you're going to see those less offers come in on those properties. Days on the market stays longer. And you'll probably go back to seeing, if you sell a house at asking price, you're doing okay. But conversely, to the buyer, of course, as rates have gone up, the same widget a year ago that cost the same costs almost 15 or 20% more in cost to buy it simply because of rates. And everything else along the line has gone up, including rates. We talk about utilities, we talk about gas, we talk about all the other factors that we sometimes don't count when it comes to home ownership. Really puts a strain on being a homeowner. So sometimes during these tough times, it's better off being a renter, because a renter, you still have a fixed expense and a fixed cost. You're not paying utilities, you're not paying garbage, you're simply paying rent, and it's up to the owner, of course, to cover those utilities. So sometimes renters can do better off in these type of markets than the actual homeowner themselves.
Something that came out is what they call the homeowner's budget. It's essentially flat from last year, just 0.3% higher than last year nationwide in the 3 months ending April 30th. It's the slowest growth rate since we've seen since 2020. So you have a budget, and what they're saying here in this kind of analysis is that when you see the budget stop growing, that's when you see a natural turn in home prices. Do you believe that, I mean, you can't, going back to the statement that I said, well, your house is only worth what somebody will pay for it. Now, if you see a year-over-year budget for housing only increase 0.03%, couldn't you just naturally say that home prices have kind of peaked right there, and that we could see with interest rates now, this isn't factoring in interest rates. This is only through April 30th. Now, it's gone up higher. So now that budget has been eaten into. So naturally, if you do the math here, home prices should fall.
Well, I agree. I believe that home prices has peaked for this time frame, at least through next year. Home prices has peaked. Well, we won't see these type of prices simply because of the cost of purchasing property, and of course more inventory, more competition. You know, we're talking about, we were talking earlier about the PGA. Now there's a new sheriff in town comes to challenge the PGA. So when there's competition, things has to change. Things become more and more flexible, more elastic. So as we see these changes come through, we were always talking about, you know, the pendulum swinging from the seller's advantage, which we have been for the last 5 years, now to a balanced market, then to a buyer's advantage. Then it kind of, we flipped the script, and now there's a new sheriff in town. So these are all the things that we have to do to pay attention to. As an investor myself, these are all the things I'm looking at. I'm looking at the foreclosures. I'm looking at all the different things that affects market conditions during these periods of time, because I've seen these periods of times come. You know, history does repeat itself, and now we just have to find a way how to navigate through it. The Fed raised from what I understand, the Fed raised their rates 0.75% because they want to accelerate this the cost quicker, so we can actually lessen the amount of time that we stay in this hypodermic type of environment.
I agree with that. It seemed very reactionary. What do you think that's going to happen when, you know, we have a lot over the last several years, we've seen people just kind of, oh, I'm not going to buy, I'm going to sit on the fence. I'm not going to buy. Oh, prices are going up. I can't save enough. But there are a lot of people who have done that, and they really do want to buy houses, right? So as we see this inventory come up, and the other part of this equation, yeah, we could see 15.9% year-over-year increase in inventory, still much lower than it was 2 years ago and 3 years ago. But as this inventory hits the market, there's still a lot of people who still want to buy a house, period. And they've been waiting for this type of environment where it's getting back towards a balanced market, maybe even into a buyer's market. And they may hope for a buyer's market. I like the fact that there are a lot of people who have been saving money. Employment is very high. We have wages that have been growing not quite as fast as home prices, but they've been keeping up in some ways. And if you're serious about buying a house, you've been working on your budget and saving money. So when this inventory hits the market, I think I'm encouraged to see that, number one, we have the products that are out there. Okay, forget about the rate for now. We have the products that will attract a lot of people. We have more inventory, which equals more choices. And a lot of people were sitting on the sidelines saying, I'm not spending that much money on that house. If I'm going to spend that much money, I'm going to spend it on that kind of house. So as we see more people taking advantage of this, you know, the peak in the market, selling, getting more inventory in the market, and then getting into, and it gives more opportunity for the people who have been sitting there waiting. There's a lot of people still looking to buy houses.
There are a lot of people.
We encourage people to call us and, you know, get pre-approved, because a lot of people. You look at this this statement right here, and when rates were 3% of 500,000, they said the average qualifying mortgage was 517,000. Today, as mortgage rates were rising, when this article was written, it was 5.29%. They only qualified for 427,000. So you can see the difference. That's a $90,000 difference just in that 2.28% in rate.
Yeah,
but
what concerns me, as noble as that sound and as arithmetically correct as it sounds, consumer sentiment kind of throws a different picture. News, people go off of news. Like culture is what's important. Even though property values might be down, when people don't feel it's the right culture, those people that are sitting on the fence will continue to sit on the fence because they believe the market's going to go lower. Those are the people we got to prime the pump on. Those are the people we got to get out back into the marketplace to kind of keep the market going, to keep the market healthy, and to keep the market balanced.
Well, thankfully, we have a workforce out there called realtors that are out there trying to earn a lot of people's business. Most realtors that I know are very pro real estate. They're pro neighborhoods, they're pro school districts, they're pro certain types of houses and neighborhoods and so on. So there's a big, huge workforce out there that's going to be, I believe, pumping real estate. And at what point, Gordon, and maybe we talk a little bit more about this, do they basically succumb to the fact that home prices might come down a little bit, or at least more inventory, or at least their sellers aren't going to get the full, what they want. It's going to be a little bit more realistic. At some point, that's going to hit the whole market, and realtors will kind of have to change their tune. I know you have a comment on that. You're going to hold back, aren't you?
I'm going to hold back.
We'll come back after this break. I'm Tony Mendez, Gordon Hines. You can always reach us at Facebook. It's Bay Area Loan Source. Or YouTube, Bay Area Loan Source. You can always call the show, 800-516-1220, 800-516-1220. We'll come back after this break.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines, on this beautiful June day of 2020. The month June is halfway over already. You realize that?
Time is clocking, as you say.
Time is clocking.
Real estate investors bought 77,000 homes in the metros tracked by Redfin in the first quarter. That's down a little bit from the fourth quarter, but still up from a year ago by 30%. So the investors are still very active. In fact, they purchased a record 20% of homes that sold in the first quarter, up from 19% in a quarter earlier, and a 15% year over year. So investors are not shying away at all from this this kind of market with higher interest rates. Gordon, do you think that as more inventory hits the market, well, the tough news here is that we just talked about how investors are still very active in the market. That means that even though we are going to see more inventory hit the market, and it already is 15.9% year over year, not as quite as high as it was 2 or 3 years ago, but still more, you're going to be competing against investors. So we're not out of the woods yet when it comes to home selling quickly, home selling over asking price, because investors are still out there.
Well, typically, if you watch time frames, normally when these type of activities happen in the marketplace, we kind of weed out the amateurs, the true investors that really understand economics, understand market trends, understand market conditions. They always see the glass as half full, where the amateur or the wannabe is always seen as half empty. So any reason that he gets a chance to doubt the market, it's almost like they say about atheists. And if you want to know anything about the Bible, talk to an atheist. They read the Bible more because they always disprove the facts rather than trying to prove. Kind of same thing when we see these kind of markets. So you got to sometimes you got to get creative. You got to think outside the box. You got to, start looking back in directions that you weren't looking before to continue if you want to be successful as an investor in this marketplace.
Investors are on the hunt for deals, according to Redfin, and are waiting for homes to linger on the market for a little bit longer. So I believe that, as active as we see investors right now, and yes, you are, a lot of these investors are very experienced. They have deeper pockets. They have thicker skin. They know how to navigate and ride out some of these troughs that we see. But they're going to be out there and very active. But, if we see more inventory hitting the market, they're looking for the deals, just like you are. If you're an investor, you're looking for that deal. If you're just buying it for a primary residence, you're looking for the same deal. So we haven't seen any signs that investors are slowing down yet. So that's a good sign for the continued in the health of the market. a lot of people have been really waiting for this type of market where more inventory hits the market. They didn't really like things going up and up and up because it just kept getting squeezed. A lot of people kept getting squeezed out. So this is healthy for the market, and it happens. It wasn't a question of if, it was a when.
Well, some of the complaints we got from buyers, time is clocking.
Well, that's the other thing, too. If you buy, every year you're putting more and more equity into your house, whether it goes up or down. Remember, if your house goes down, it doesn't mean that your value's down because you have to sell it in order to capture a loss. You only lose it if you sell it. We'll come back after this break. I'm Tony Mendes at Gordon Hines. You can always reach out to us. Bay Area Loan Source is our website. Tony or Gordon at bayarealoansource.com is our email. We encourage you to reach out and give us any comments. We'll come back after this break here on AM 1220 KDOW.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
So a lot of people during the pandemic, are we still in a pandemic? Do you call it pandemic or an endemic? Which one do you figure that?
I think the relative, the answer is the same. It's a problem time.
It's a problem. A lot of people bought homes in a competitive market, and they had to buy property in cash. There's something called delayed financing you can do. If you bought a property in cash, you can get your cash out right away. In fact, the day after you buy it in cash, you can do what they call a delayed financing transaction to get your money out. But and there's products for it. Yeah, okay, the rates are what they are. You go with the flow. But what about we've run a couple questions about using future value. Now, a lot of people who buy homes, they fix them up, and then how soon can you use the future value on a property to cash out on?
Well, I think
that higher value.
I think typically Fannie Mae, I think a 6 months requirement for if you want to use a higher value. So if you bought a property today and you bought it for $100,000, it's worth $300,000. In order to see that value, that increase in value as far as application is concerned, you want to hold that property for 6 months, unless you can show that what you have done to the property to improve the value. Yes. So in other words, let's say you added a second bedroom and a half a bath, and now it's instead of 2-1, it's a 3-bedroom, 2-bath. And of course, now the comparables are 3-bedroom, 2-bath. That's one way to circumstance the issue about the 6 months.
And it's all about documentation. Yeah. We've actually sat down with clients before and had tables full of receipts. In fact, you can use a higher value on a property if you can show the dollar amount and what you spent on the property. So if you bought a house for $1 million and you put $100,000 into it, all receipted, all documented, and now it's worth. They'll use that value now, the 1.1, because instead of the 1 million. Now you can wait till 6 months later, but a lot of people don't. They want to use it right away. So there's a lot of. We keep talking about how products are still here, and that's also very exciting for the industry. And we're proud to say that we use all of these products. Delayed financing, we have all the non-qualified mortgage products, bank statement products, which are very popular. The DSCR, which stands for Debt Service Ratio Cover. Debt Service Cover Ratio. And that's fantastic for investors. They even have no ratio DSCR loans. You have to have higher credit scores, and the rate's a little bit higher. So there's all of these products out there for almost everybody. And, then FHA comes out, and they were going to loosen a little bit of guidelines on employment and verification of employment. So we're excited to say that. There is still, just because interest rates go up doesn't mean that the market's going to tank.
Or the market shuts down. A lot of times, as we always talk on the show, it's products that's what makes the market go. Of course, the market works on energy, and the more products we have, the more products we interject, we can bring more and more buyers to the table. You just mentioned the DCR program for the self-employed borrowers. We use a lot of bank statement loans. What we do, we take 12 months bank statements, add up all your deposits, less transfer, divided by 12, and come up with an income. So that's a product that wasn't available many years ago. So as the market gives, it takes, and that's what we're always talking about. And that is how you keep a market healthy. You got to keep adding people, just like in basketball, the Warriors. If you want to continue to keep a championship team every year, you got to add another piece because everybody's focus on your last piece. You got to add something new to the pie if you want to continue to have a success in what you do.
They also figure you out. We're not going to get
Well,
into
when they
basketball
figure you out,
analysis.
that's why you add
gotta
another
kind of
piece. But
switch it
once
up.
they figure you out, you add another piece, and that's what we're doing in our market. By adding another piece, meaning this in our marketplace, it's another product which can bring another buyer that wasn't available last year or last week or yesterday that we can finance to the table, and of course that's increased volume. And once again, everybody's happy.
Yeah, so these products keep hitting the market. I like the email that we got not too long ago about somebody who was buying their property from their landlord, and they wanted to get a loan on it, but they also wanted they weren't on title, right? So you have to season yourself on title. What was the answer on that one? Do you remember?
Yeah, in order to typically you're looking. Well, it depends on what you're trying to do. If it's a rate and term, meaning not taking cash out, you just refinance a loan for its balance. Season on title is we just have to prove you're on title. We just have to actually get an actual credit report. A title report to prove that you are on title to do a rate and term finance. If you want to do cash out, I think it's 12 months.
Yeah.
I'm sure that you've been making payments. Proof of you've been making payments in order to use that in order to take cash out.
And I wanted to bring that up. You also mentioned about the bank statement product. One of the biggest issues we run across with self-employed people who are, they own a business, they're getting a lot of deposits, is they don't do the accounting properly. You'd have to say that's one of the biggest issues that we run across. Is just deposits are going everywhere. They have some money's going to personal accounts, some going to business accounts. It's just not consistent. They switch banks. I think that the best thing that you can do is get your accounting straight. Ideally, you want to use what they call 24 months bank statements instead of 12. The longer you can prove that you've been making the money and it's been consistent, the lower the interest rate. You can even do 6 months bank statement products, but your rate is higher. So you really want to show consistency, and it's not about just consistently earning money. It's documenting it, because this is your income. This is the way that you have to now prove money. Now, if you don't use a bank statement product, you're using your Schedule C or your tax return income, which is usually much lower. So that's why this bank statement product is out there. We like it a lot. We've been using it quite often in the last 12 months. It's just picked up a lot.
Well, I'm not sure if I'm going to agree with you that most self-employed people is because of accounting. I think the reason why self-employed people don't have income because they want to cheat our uncle. That's why they want to deprive our uncle of collecting ducats from them. So therefore, they show as little money as possible, just enough to get by, because they don't have to do it like the wage earner, because their money's a documented W-2 or 1099. But different things happen, different marketplaces. Of course, there's different things, and every situation is a little bit different, especially when it comes to financing. We always address what's in front of on your plate, what's in front of you, especially when it comes to credit score and analysis and those type of things, because that's how we judge ourselves, by what we can do for each other, not what the neighbor has done, not what Tom has done. Yes?
I agree with that. These are products that we didn't have 16, 18 months ago, and they've been coming back into the market. And they're becoming more and more popular because more people now know that these products are out there. We, of course, are, singing it, putting it across the wire, letting people know, letting clients know, letting realtors know. These products can be used for purchasing or refinance. A lot of times people don't realize that, and they're not as stringent on income, but they are stringent on credit scores. They are credit score based, of course, and you have to have reserves. It's a formula. It's not throw it up against the wall, let it stick, and you have a loan. Things still have to make sense. We still have to go through the appraisal process, the credit process, credit level explanation, all those kind of things. The only thing is they don't factor the debt ratio, because typically there is no income on the DCR program, because it's strictly based on the amounts of rents. Yeah, if I was going to give anyone a piece of advice, and you mentioned this just a moment ago about credit. Credit is still a major driver behind what kind of products and interest rates and what they call loan to value. How much cash out can you get? And ultimately what rate and what you're paying. I would work on my credit score. I would instantly tonight go and get Credit Karma, or go to your credit card and get whatever service they offer, and monitor your credit, and then work on your credit and get that as high as possible. If you're going to, especially if you're eager and you're loving this news, you're incredibly optimistic that we're going to see more inventory, more choices on the market, and you are a buyer, I would instantly go get your credit. Still, 50% of the people out there that are walking around looking to buy a house have not seen their credit in the last year, which is amazing. They should see it every year, minimum 6 months. I would say every year, but I think every 6 months. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines, the maestro. You can always reach us at BayAreaLoanSource.com. That's on Facebook and YouTube as well, and LinkedIn. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines here on the Real Estate Report on AM 1220 KDOW.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
I know what I want to say this word, Gordon, normal. A return to normal is probably pretty far off, but cracks are starting to emerge in the seller's market that has defined the real estate industry throughout the pandemic period, according to this this one article. How do you read into that, Gordon? There's so many things that go into it. We just went through everything from there's a lot of buyers still out there sitting on the fence. Interest rates are rising. Affordability is going down. Home prices are peaked. Sellers don't want to sell their houses and get out of their 3% rate just to get into something that's, by the way, at 5.78%, according to Freddie Mac Weekly Survey. And, of course, that differs. And it keeps going on. All of these mathematical factors that go into our home price is going to go up or down. We've kind of slowly been eking into this theme about, what's going to happen this summer. Are you ready to make any predictions about this?
Well, yes, I am.
No. Are you? Yes, you're ready to make predictions.
I am. I'm not making predictions based on a crystal ball. I'm just making predictions based on the economic culture that we're in right now. As you just mentioned, as rates have gone up, right? We know that for a fact. The cost of home ownership has gone up. We know that for a fact. The amount of properties coming to market are more now than they were before. We know that for a fact. All that goes into evaluation. One of the biggest complaints we got from a lot of our clients that were bidding on houses, that they were tired of bidding because they thought they never stood a chance. When I remember we had a guy that bid $355,000 over asking price and did not get it. Boy, was he upset. He said, Gordon, I put my best foot forward. I really, really, really wanted this property. It had everything I wanted. It had a pool. It had a view. It had the au pair for his mother-in-law to live in, and he didn't get it.
Did everything right.
He did everything right. So these are the people, and so sometimes you get tired of that process. A lot of times people just shelf themselves for a while, and it says, well, let me know, wake me up. When the market has changed. And I think now, if you're a realtor, you should be starting to wake these people up. Hey, listen, there's change coming. And now might be a better opportunity. Instead of now you got 2 offers. We talked last week, got a client that had a nice property for sale. She only got 2 offers. So she took the higher of her 2. And now she's about to close, because it's a cash deal, actually. It's about to close at the end of the month. So these things, once again, behind every dark cloud is a silver lining. We believe there is a silver lining behind this dark cloud. So dark cloud might be for the sellers, but the silver lining probably is a buyer.
See, I find it that, okay, there's a prediction right there. You just said it was a dark cloud. I don't know if I can see that quite yet, Gordon. We just don't see it. We don't have enough numbers. We haven't seen it really affecting home prices
because the market works on lag. The information that we're working on. You just mentioned we closed 77,000 homes between January and now, but that was based upon rates in the 4s. Now I guarantee you, if you were to take the same 6-month period from July 1st to December, we won't close 77,000 because the rates are higher.
I'm not arguing with the math. I'm arguing with the fact that you're committing to that guarantee that we're going to see that.
Well, I'm taking an economic educated assumption based upon market conditions.
Well, I want to turn
I'm not pulling these numbers out of a hat.
No. But I think that I want to turn that. I don't think it's a dark period, like the dark ages of real estate, by any means. I think that there's a lot of people who can spin it that way. I don't know if I don't want to spin it that way, and I'm not saying that you are, by no means. I'm talking about your commitment to that, but I see plenty of buyers still out there. We still get plenty of calls. People looking for pre-approvals. Of course, they're disappointed to see that interest rates have eaten into their ability to buy, more than eaten into that buying power, which we already know is going to happen. It's just the math behind it. But there's still plenty of people out there. So it's just going to take a readjustment, right? It's going to get back to, again, I know you don't like this word, normalcy. Let's call it balanced, where it's fair on both sides. We won't see, that today, I bet you that person would take the 350 over.
Well,
right? Because they may not. I mean, that might be the only offer that went over.
Well, when opportunity knocks, you present itself. You probably capitalize on it. If you're a seller and you have the option of doing seller financing, if you can get a 6% return on your money, even though now your valuation has dropped, you're not getting this for enough that you would have gotten probably 6 months ago. But you can make that money up by financing the property. A lot of times, once again, those are other opportunities. They're not going to be as strict as credit as long as you have enough down payment skin in the game where he or she feels comfortable in providing finance. And these are the things that we typically see when we see interest rates rise in a short period of time like this. People look for different alternatives. We look for different ways to finance things. We look for many, many methods. And as we talked before, we will hopefully see Fannie Mae would come back with some type of seller-assisted finance, the 80-10-10s, and that way, once again, the market can begin to expand.
You hit a lot. I like that too. I think a market like this with lower volume, I think Fannie Mae and Freddie Mac, they're going to see a lot of pressure to open up their guidelines, continuing to try to free up a little bit more accessibility for buyers, but also getting back to normal. Talking about the amount of buyers that are out there just sitting that have been waiting for a long period of time. That's exciting to me. The options that are available. I'm pretty optimistic that when you see more choices, I think we're going to see people saying, you know what, I've been waiting for a house in this neighborhood, or I've been waiting for that particular house or into that school district. And that also, I think sellers need to listen to this as well. If you have a house that just isn't quite up to par, you might be spending some more money. Yeah, okay, paint is expensive and wood is expensive. That's coming down, by the way. But to fix up your house and really put it out there, you can't get away with just not doing enough on your house to get it sold for top dollar and over asking price, all that stuff. You're going to need to do stuff. So I think this is getting us back to the normal things that we usually do. So when we say normal, I think we can use that in that situation.
No, you just like that word normal, and I'm trying to get you out of that normal, because every time you do something different, you're establishing a normal. You're drawing a line in the sand, in other words. And I'm trying to move that line.
Is that your normal answer?
I'm trying to move that line.
That's your normal answer, isn't it?
An abnormal answer.
AB normal. Well, go Warriors. I'll be at the parade. I know that. It'll be in San Francisco instead of Oakland.
I'll be in Boston.
We'll come back next week. Thanks for joining us. You can always reach us, Tony or Gordon, at BayAreaLoanSource.com. That's our website. You can reach us on YouTube and Facebook, Bay Area Loan Source. Thanks for joining us. We'll come back next week here on AM 1220 KDOW.